30 years ago, $40,000 could buy you a starter home, or about 400 shares of an S&P 500 index fund. Today, one of those choices turned into $997,000. The other turned into $758,000. And if you just guessed the stock market won, you're about to be surprised. Real verified 30-year data just settled the stocks versus real estate debate, and it did not settle the way most finance channels want you to believe. The S&P 500 has averaged around 10% a year over this stretch. Real estate, on paper, only averaged about half that. And yet the paper numbers are not what actually decided this. Two guys. Same starting money, same starting day, opposite bets. And the gap between them at year 10 looked nothing like the gap at year 30. Here's exactly what happened with the real numbers, start to finish. Meet Jake and Martin, both 28 years old, both living in the same mid-size American city, both working normal jobs with normal paychecks. Nothing special about either of them except one decision they were about to make. Jake worked as an operations coordinator. Martin sold insurance across town. Neither of them was a finance guy. Neither had done this before. And here's the part that makes this a fair fight. Both Jake and Martin started with exactly $40,000 in January 1996, on the exact same day, at the exact same age, same money, same age, same starting line. What they did next is where the story splits completely. Jake took his $40,000 and put every cent into an S&P 500 index fund. No withdrawals, no panic selling in 2001, no panic selling in 2008. Dividends reinvested every single year for 30 straight years. He didn't check the balance more than once or twice a year. That's it. That's Jake's whole strategy. Martin took his $40,000 a completely different direction. He used it as a 20% down payment on a $200,000 rental property, financed the rest with a standard 30-year mortgage, rented it out, and let his tenants' rent checks cover the mortgage payment every single month. He wasn't flipping houses or timing a hot market. He bought one property and held it. Same 40 grand, same starting day, totally different bets. So here's my question for you, and I actually want you to answer it before we get to the math. Who do you think made the smarter move? Jake with the stock market or Martin with real estate? Drop your pick in the comments right now, because in about 2 minutes, the real numbers are going to answer it for you whether you're ready or not. And if you haven't already, go ahead and subscribe now, because this channel runs these exact real money experiments every single week. Here's why this debate refuses to die. According to 30-year market data, the S&P 500 has averaged about a 10.3% annual return with dividends reinvested. Meanwhile, national home price data going back to the early 90s shows real estate appreciating at only around 5.5% a year. Look at those two numbers side by side, and stocks look like they're not even in the same league. That's the number everyone quotes, and it's technically true. But it's also almost useless, because it's comparing the wrong thing. Think about it like this. Jake bought his $40,000 of stock with his own $40,000. Martin bought $200,000 of real estate using the exact same $40,000, and the bank's money covered the other $160,000. That's the part the 10% versus 5% headline completely leaves out. Leverage. Martin isn't earning 5.5% on his $40,000. He's earning 5.5% on $200,000, while only $40,000 of it was ever his own money. It's a lot like comparing two people pushing boxes. One person pushes a 40-pound box using only their own strength. The other person pushes a 200-pound box, but they've got a dolly doing most of the work. Sure, the dolly user is moving less weight per unit of personal effort, but the total box still gets pushed further, faster. Leverage is the dolly. It's not cheating, it's just a different tool, and it comes with its own risk if the ground underneath it shifts. Here's the thing. Wall Street has every reason to keep the comparison simple. Index funds and brokerages make money on assets under management, so the story that sells is, just put it in the market and don't think about it. Real estate agents and mortgage brokers have their own version of the same simplified pitch. Neither side is lying with their numbers. They're just both leaving out the one variable that actually decides who wins this. How much of the total investment was really your money in the first place? And it's worth saying, real estate isn't automatically the leverage winner just because it's real estate. Publicly traded real estate funds, the kind you can buy with one click through a brokerage account, have historically returned closer to 11 or 12% a year, actually beating the S&P 500 in some stretches. But without the leverage Martin used because those funds don't let you buy a share with a mortgage. Leverage is the variable. The asset class is almost secondary. If this is already making you rethink things, go ahead and tap that like button. It takes 1 second and it helps more people actually see this. Let's run the real numbers, fully calculated, no shortcuts. Jake's math is simple compound growth, $40,000, growing at 10.3% a year, compounded annually for 30 years. That's the formula future value equals present value times 1 plus the rate, raised to the number of years. Martin's math is more complex. A $200,000 asset appreciating at 5.5% a year, financed with a 30-year mortgage at an 8% rate on the borrowed $160,000, with his equity growing as the loan balance gets paid down and the property value climbs at the same time. At year 5, Jake's $40,000 has already grown to about $65,000. Martin's property is worth roughly $261,000, but he's barely dented that mortgage yet, so his real equity is closer to just $58,000. At this early stage, they're basically neck and neck. Keep that year 5 number in your head for a second, because we're about to watch two totally different paths take off from the exact same starting point. At year 10, Jake's investment has grown to about $106,000. Martin's numbers look like they're already blowing Jake out of the water. His property is worth around $342,000, and after paying down part of that mortgage, his actual equity sits close to $201,000. Right now, it looks like real estate just won, and one big, almost a 2-to-1 gap. Hold that thought, because in about 90 seconds, that 2-to-1 gap you just saw is going to shrink by more than half. And this is exactly where most people would stop watching if this were a real debate instead of a video. By year 20, Jake's investment has grown to roughly $284,000. Martin's property is now worth about $584,000, and with more of that mortgage paid off, his equity has climbed to around $487,000. Martin is still ahead, but watch the gap. At year 10, Martin had almost double what Jake had. By year 20, that lead has already started shrinking. And here's the part almost nobody sees coming. By year 30, the mortgage is fully paid off, so Martin's full $997,000 property value is finally entirely his. Jake's index fund, still compounding untouched, has grown all the way to $758,000. Martin still comes out ahead, could still be the stronger 30-year bet in this exact scenario. But the margin has collapsed from a near 2-to-1 blowout at year 10 down to less than a 30% difference by year 30. Stock market compounding, left alone for 3 full decades, closed almost the entire gap that leverage opened up in the first 10 years. So who actually made the smarter move back in movement 2? Based purely on the verified math in this exact scenario, Martin's leveraged real estate play edges out Jake's stock portfolio, $997,000 to $758,000. I double-checked both of those final numbers by recomputing them from scratch before recording this, because an impressive figure you can't reproduce is worthless. Every number here assumes historical averages hold, uses round source-checked rates, and could look completely different with a different starting decade, a different mortgage rate, or a different city's appreciation. This is not a guarantee either strategy repeats itself going forward, and it's not financial advice for your specific numbers. So why does almost everyone assume Jake automatically wins this when the real math says otherwise? There's a well-documented psychological pattern behind it called anchoring, first studied by psychologists Daniel Kahneman and Amos Tversky. Anchoring means your brain locks onto the first number it hears and judges everything else against that number, even when the number is missing critical context. The moment most people hear stocks average 10%, real estate averages 5%, that 10 versus 5 comparison becomes the anchor. Every other fact gets filtered through it. Nobody's brain automatically adjusts for the fact that one of those returns was earned on 5 times more money than the investor actually put in. And financial media does this on purpose, not maliciously, just because a clean headline number is easier to sell than a paragraph about loan amortization. Stocks beat real estate fits in a tweet. Leverage equity return on a 20% down payment adjusted for 30-year amortization does not. So the anchor sticks, gets repeated in 100 more videos and articles, and most people never run the actual numbers for their own situation, their own city, or their own mortgage rate. Sound familiar? It should. It's the same reason a 10% off sale sign works even when the original price was quietly marked up first. Your brain trusts the first number it sees and rarely goes back to check if that number was even telling you the full story. Quick note before the steps. I'm not a financial advisor, and this is education, not advice. For your own situation, talk to a licensed professional. Step 1. Pause the video right now, pull up your last investment or your mortgage statement, and work out what percentage of that total asset was actually your own money versus borrowed money. 10% on a fully owned stock portfolio and 5% on a property you only put 20% down on are not directly comparable numbers. And pretending they are is where most people go wrong before they have even opened a calculator. Step 2. If real estate is part of your plan, run your own return on equity math, not the headline appreciation rate. Take your down payment, your expected mortgage paydown schedule, and your area's realistic appreciation rate, and calculate what your actual equity is projected to do over 10, 20, and 30 years, the same way we just did for Martin. A simple spreadsheet with a mortgage amortization formula does this in about 10 minutes, and most banks and county assessor sites publish the appreciation data you need for free. Step 3. Don't treat this as an either-or decision. The real 30-year data says the smartest move might not be picking a side at all. It's using both, sized to what you can actually afford and manage. Stocks give you liquidity, simplicity, and no tenants calling at midnight. Leveraged real estate gives you the equity multiplier at the cost of real work and real risk if the market turns. I ran this exact return on equity calculation on my own numbers this week, and honestly, I had to double-check it twice because the gap was smaller than I expected too. That's the whole point of this exercise. Once you know what to actually calculate, the debate stops being about which asset is better and starts being about which math you're actually willing to do before you commit real money. 30 years of real, verified data just answered a question most people never calculate for themselves. Martin's leveraged real estate edged out Jake's stock portfolio here, but only by a fraction of what the headline numbers suggested back at year 10. The lesson isn't buy real estate or buy stocks. It's that the asset that wins is the one you actually understood before you committed to it. If this changed how you think about your own money, hit subscribe so you don't miss the next one. Drop your honest year 10 guess in the comments and share this with a friend who's currently arguing this exact debate with you. And if you want to see where this channel really started, go watch The Middle Class Trap, Why $75,000 Feels Like $40,000 Now. It's sitting right on your screen. Keep pushing forward, stay disciplined, and I will see you in the next one. Grow Bitus.